Hey everybody, Brian Kane here. Today I wanted to talk about capital gains in real estate. Now I want to qualify this, I am not a CPA, but I do want to let you know some important information that you can go back and verify with your tax professional when you're considering selling a property. By now, many of you have heard of the Section 121 with the IRS, more commonly known as the 2 out of 5 rule, which means if a home has been your primary residence for 2 consecutive years out of the last 5, then you most likely qualify for the 121 exemption, which as an individual gives you up to $250,000 of gain tax-free, or if you're married, it gives you up to $500,000 of gain tax-free. So let's see how this works. Let's say you bought your property for $500,000, and then over the years, you put about $50,000 of capital improvements into the property. Maybe you replaced the roof, put in new air conditioning, put in some new windows, whatever it might be. Well, you take your first $500,000 as your original basis, because that's what you paid for the home. You then add in your capital improvements, in this case, let's say $50,000, so that your new base is $550,000. This means when you go to sell the property, after all of your cost of sale, anything $1,050,000 or less would come to you tax-free. That's right, so let's say you sold the property for $1.1 million. You paid your listing agent their commission. You provided the buyer some concessions for whatever they may request. You paid your title and escrow company, you paid your county transfer taxes, all of that. And after you sell your home for $1.1 million, you're left with $1,050,000. Well, since your tax base is only $550,000, you take $1,050,000, subtract $550,000, that comes to $500,000 of gain. And if the home has been your primary residence for 2 consecutive years out of the last 5, that means that $500,000 is exempt from capital gains tax. Again, make sure to talk to your tax professional about your specific scenario, but that is one way that home ownership helps people build generational wealth, something I'm extremely passionate about. Let's talk about another way. What if a home doesn't qualify as your primary residence, meaning it hasn't been somewhere that you've lived for 2 consecutive years out of the last 5? Maybe it was a rental. Maybe it was a property you lived in at one time, but you've had it as a rental for the last 6 or 7 years. Or there's one very, very common way to not have to pay in the immediate year that you sell capital gains taxes. And one way is to do a 1031 tax-deferred exchange, also commonly known as a 1031 exchange. So in a 1031 exchange, this means when you sell that investment property, let's say for $1 million, so long as you buy a replacement property or a set of properties that add up to at least $1 million or more, that'll qualify you for a 1031 tax-deferred exchange. There are a couple of other rules, so you're going to want to seek out a 1031 exchange expert, or of course contact our office and we can give you more information. But by doing a 1031 exchange, you effectively do just that. You defer any capital gains taxes down the road. Let's say you bought an investment property for $500,000, you sold it for $1 million. Rather than paying taxes on, let's say, $500,000 worth of gain, you can instead take that $1 million and buy a new property, pay no capital gains at the time, and continue moving your investment portfolio forward without the bothersome taxes you might have to pay if you had to pay those capital gains taxes. There's other opportunities as well. In fact, we've got a client right now that we're selling a property and they're doing what's called a structured settlement. It's also considered a structured annuity settlement. So for some folks, let's say they've owned a property for years and years and years. They bought it for $300,000. They've depreciated the property all the way down to zero. And now let's say that property is worth $2 million. Let's just say it's a fourplex somewhere in San Diego. And they want to sell the property, but $2 million, boy, could you imagine the taxes you'd have to pay on $2 million? Well, one thing that's possible is what's called a structured settlement. But the basics are this. You can sell that property for, let's say, $2 million, and then stretch the receipt of that gain over the next 5 years, let's say, in what's called a structured annuity. So essentially, you take the $2 million that you are going to earn from the sale, you put it into a structured settlement, which is a purchase of an annuity or the similar, and then that annuity pays you over a period of time, let's just say 5 years. So you can start to receive, for example, $400,000 a year over the next 5 years with interest as well that's paid on the annuity. And that'll minimize the tax burden versus paying taxes on a $2 million worth of capital gains in year one. So that is another way to avoid paying all that capital gains in the year that you sell the property. So let's review. If you're a property owner and one reason that you're being held back or not considering selling a property is because you're concerned about the taxes, well, your property may qualify for one of three strategies. One, as a primary residence, you may qualify for the 121 exemption, which gives you up to $500,000 of gain tax-free on the sale of a primary residence. Or you may qualify for a 1031 tax-deferred exchange, which allows you to defer those taxes down the road into a different property when you eventually may want to sell and cash out. Or you can consider a structured settlement sale, which spreads out the proceeds in the years to come. In either way, we're here to help you make the right decision on your real estate when the time comes. Feel free to reach out. We're happy to chat.